It is the biggest investment fraud in history. There you are, folks. And 10 years later, thousands of victims of Bernie Madoff's epic fraud are still struggling to put their lives back together.
The architect of the largest Ponzi scheme in American history died today.
Ponzi scheme seemed to have become the order of the day. First it was the infamous IMA scandal.
Another Ponzi scam comes to light in the city, a company called Default.
What's happening inside this Pompano Beach business?
Charles Ponzi's Ponzi scheme. The original Ponzi scheme was created by Charles Ponzi in the early 20th century. He promised high returns on investments in international reply coupons and used money from new investors to pay returns to early investors. The South Sea Company. The South Sea Company was a British joint stock company that was established in the early 18th century with the goal of trading with South America. The company's stock price rose rapidly, leading many people to invest in the company with the hope of getting rich quickly. However, the company was eventually revealed to be a speculative bubble and its stock price plummeted, causing many people to lose their savings. The Tulip Mania. The Tulip Mania was a speculative bubble that occurred in the Dutch Republic in the early 17th century. Tulips were introduced to the Netherlands from the Ottoman Empire, and their popularity as a decorative flower led to their price increasing rapidly. Many people invested in tulips with the hope of making a profit, but eventually the bubble burst and the price of tulips plummeted, causing many people to lose their savings. The Mississippi Company. The Mississippi Company was a French company established in the late 17th century to trade with the Mississippi Valley in North America. The company's stock price rose rapidly, leading many people to invest in the company with the hope of getting rich quickly. However, the company was eventually revealed to be a speculative bubble and its stock price plummeted, causing many people to lose their savings. The British South Sea Bubble. The British South Sea Bubble was a speculative bubble that occurred in Britain in the early 18th century. The South Sea Company, which had been established to trade with South America, became the subject of a speculative bubble, with its stock price rising rapidly. Many people invested in the company with the hope of making a profit, but eventually the bubble burst and the price of the company's stock plummeted, causing many people to lose their savings. The Nifty 50. The Nifty 50 was a group of 50 blue-chip stocks that were popular in the 1960s and 1970s. The stocks were seen as one-decision investments that would provide steady gains and long-term wealth. However, the stocks eventually fell out of favor and many people who had invested in them with the hope of getting rich quickly lost money. The dot-com bubble. The dot-com bubble was a speculative bubble that occurred in the late 1990s and early 2000s. Many people invested in technology companies with the hope of getting rich quickly, but eventually the bubble burst and many of these companies went bankrupt, causing many people to lose their savings. Pyramid schemes. Participants are asked to recruit others to join the scheme and are promised a commission for each new recruit. Ponzi schemes. Participants are promised high returns on their investments, but the returns are paid using money from new investors, rather than from profits earned. Investment scams. Participants are promised high returns on investment opportunities that turn out to be fraudulent or non-existent. Multi-level marketing, MLM, scams. Participants are asked to sell products and recruit others to join the scheme, but the products are often overpriced and the opportunity for financial gain is limited. Forex and binary options trading scams. Participants are promised high returns from online trading, but the returns are often based on false information or manipulation of the markets. False promises of high returns. Participants are promised high returns on their investments with little to no risk, which can be tempting for those looking to build wealth quickly. Social proof. The schemes often use testimonials from other participants who claim to have made significant profits, created a sense of legitimacy and encouraged others to join. Urgency. Participants are often told that there is a limited time to join the scheme and that they will miss out on the opportunity to get rich if they don't act fast. Emotional appeals. The schemes may play on people's desires for financial security and independence, tapping into their emotions and making it difficult for them to resist. Complexity. The schemes may use technical language and financial jargon to make it difficult for participants to fully understand the risks involved, making them more susceptible to joining. In most cases, only the creators and operators of get-rich-quick schemes make money from them. These schemes are often structured in a way that a small number of people at the top of the pyramid benefit, while the majority of participants lose money. For example, in a pyramid scheme, the early participants may make money by recruiting others, but eventually the scheme will collapse as there are not enough new recruits to sustain the pyramid. In a Ponzi scheme, the operator may use the investments from new participants to pay returns to early investors, creating the illusion of a successful and profitable investment opportunity. But eventually the scheme will collapse when the operator runs out of money. Be wary of promises of high returns with low risk. Most investment opportunities that promise high returns with low risk are too good to be true. Be cautious of any investment that promises returns that are significantly higher than what is offered by conventional investments, such as stocks or bonds. Research the opportunity thoroughly. Before investing your money, do your due diligence and research the opportunity thoroughly. Check the company's background, track record, and financial statements. Look for red flags, such as a lack of transparency or a history of complaints from other investors. Invest in a diversified portfolio. Don't put all your eggs in one basket. Instead, invest in a diversified portfolio of assets, such as stocks, bonds, and real estate, to reduce your risk. Consult with a financial advisor. If you're considering an investment opportunity, consult with a financial advisor or investment professional. They can help you evaluate the opportunity and determine whether it's a good fit for your investment goals and risk tolerance. Be skeptical of unsolicited offers. Be wary of unsolicited offers, such as phone calls or emails from people you don't know, offering investment opportunities. These offers are often part of a scam. Remember, if an investment opportunity sounds too good to be true, it probably is. Be cautious of any opportunity that promises high returns with little risk, and always do your research before investing your money. If you like our video, like it, subscribe to our channel and click the notification bell to watch new contents.